Hello everyone, welcome to Commerce Logic. Today we are going to discuss about capital budgeting. So let's move on to the topic of capital budgeting. So here's the definition of capital budgeting. Capital budgeting is the process of evaluating and selecting the long-term investments which are consistent with goal of the shareholders wealth maximization. In the previous video also we have seen that capital budgeting will always deals with the investments in long term investments. So here also the same thing. This is about evaluating and selecting the long term investments to earn the goal of shareholders. What is the goal of shareholders? That is wealth maximization. Then next, there is another definition of this capital budgeting, that is it is used interchangeably with capital expenditure. We can also call this capital budgeting as capital expenditure because we have discussed that budgeting is a plan of expenditure. So capital budgeting is a plan of capital expenditure. So these two terms are used interchangeably. Then capital expenditure management, long term investment decision, and management of fixed assets. So, these are the things we can interchangeably use with capital budgeting. Then, next, this is the importance and definition of then next. Here we are going to see this last rationale. Underlying the cash budgeting and decision is efficiency. And next, capital budgeting process. Capital budgeting process refers to the total process of generating, evaluating, selecting, and follow up on financial expenditure alternatives. As we have seen this, capital budgeting is the process of evaluating, selecting a long-term investment decision. This is an alternative of that previous one. And next, the firm allocates the financial resources to the new investment proposals. Yes, of course, the firm allocates its financial resources to new investment. That means it looks after the new investments. Basically, the firm may be confronted with three types of capital decisions. Now we'll see what are they. First one is accept and reject decision. Whether you will accept or reject the decision. Then mutually exclusive choice decisions. This we'll see in next video. And now capital budgeting techniques. We'll see about capital budgeting techniques now. First one is traditional or non-discounting techniques. Then second one is non-traditional or discounting techniques. These are the two techniques of capital budgeting. We'll see now what are traditional or non-discounting techniques. See, first one is payback period and second one is accounting rate of return. These are the two techniques of traditional and non-discounting. Now we'll see non-traditional and discounting techniques. There are 5 techniques here. In this, net present value, profitability index, internal rate of return, discounted payback period, and modified internal rate of return. In this, we are going to study net present value, profitability index, internal rate of return, discount and payback period, modified internal rate of return. So, these are the important ones we are going to study. First, we discuss about payback period. See, it is the length of time period required to recover initial cost of the project. That means at commencement of business you may invest some amount of money. In this payback period you are going to calculate the time period to recover the invested amount at the time of commencement of a business. See, in simple words, if you have invested 10,000 or so 20,000 in some business, then you are going to calculate what is the time period you would be taking the invested 20,000 amount. Then, in other words, finding out the time period of recovering the invested amount in the project. So, the formula for this is payback period is equal to initial investment by annual cash inflow. This would be better understood with the help of an example. Now, I am adding here. First one is say for example initial investment is 1,50,000. That means you have invested this 1,50,000 in an project. Then expected cash flows are 50,000 for 8 years. For 8 years expected cash flows are 50,000 per annum. Now we will calculate what is the payback period for this. That means how much time you will take to uh, gain 1,50,000. This is your initial investment amount. So payback period is 1,50,000. Our formula we know. Then initial investment by cash flows. If you substitute these two things in a formula, you are going to get 3 years. That means this project is accepted because you are investing 1,50,000 in a project and your cash flows are 50,000 per annum, and if you are dividing this 1,50,000 with 50,000, you are getting 3 years. So this project will be accepted in what way? So here I have given this 50,000 for 8 years, but you are ascertaining only 3 years. That means in these 3 years you are gaining this initial investment amount, that is 1,50,000 amount. It is lesser period than this 8 years. So undoubtedly it can be acceptable because you need not wait 8 years for recovering your initial amount. You can only wait for 3 years. Within 3 years you can gain your initial invested amount. So this can be accepted. And so this can be explained with the help of another example, that is 1,50,000 is your initial investment and expected cash flows are 15,000 per annum for 8 years. So here the change is only 50,000, 15,000 is here and 50,000 is here. So now we'll see what is the payback period here now. See, the payback period, again we will substitute these things in a formula. Initial investment is 1,50,000 and expected cash flows are 50,000. Then you are incurring 10 years as the answer. Then here the project is rejected. Here it is accepted. Why it is rejected here? Because we are taking a time of 10 years to recover this 1,50,000 amount. So 10 years is more than our predetermined period. So what is our predetermined period? 8 years. But within 8 years we are not able to recover our initial investment. So we are going to reject this proposal because 50,000 annual, 15,000 annual cash flows are not at all enough to recover in 8 years. So it is taking 10 years to recover the initial investment amount. So this is going to be rejected. I think you have cleared this concept of payback period with these two examples. And now we'll see other method, that is accounting rate of return. On the basis of accounting profit and not on cash flows. ARR is annualized net income earned on the average funds invested in the project. Similar to the rate of return on capital employed, it is expressed as a percentage on the net investment in the project. It is expressed in the form of a formula, that is average annual profits by average net investments. We'll see this also with the help of an example. See here, there are annual average profits are 40,000 and average net investments are 2 lakhs. We are going to find out the accounting rate of return. Just like if you substitute in the formulas, we will get accounting rate of return. It is 40,000 by 2 lakhs, that is 20%. And next, we are going to see non-traditional or discounted techniques. In that, it is first of all, it is called as time adjusted technique. All inflows and cash outflows are discounted to find out net present value. Next, they are used to incorporate time value of money. Next, we will see the concept of time value of money. So, the rate of return that an investor can earn by reinvesting its present money. You are earning income and then you are investing. By the investing, you are going to earn some income, and again that earned income will be reinvested in some other investments. So, this is how the rate of return of an investor can earn by reinvesting the present money. You are going to invest your present money into other investing activities. Then, as per English proverb, time value of money is like a bird in the hand is worth two in the bush. And next, net present value. This is a discounting technique. Present value cash inflows minus cash outflows. The difference between these two is called as net present value. If net present value is positive, then accept it. If net present value is not positive, that is negative, then reject the project. Next, profitability index. We'll see now what is profitability index. First one is, it is a variant of NPV technique. Next, it is also known as benefit cost ratio, present value index, desirability factor. Next, it is based on the discounting factor technique. Next, profitability index is a benefit for every rupee invested in the proposal. Then again, with the help of a formula, we are going to find out this profitability index. Present value cash inflows by present value cash outflows. If PI, that means profitability index, is greater than 1, then it is positive. Next, if PI, that means profitability index, is equal to 1, then it is NPV equal to 0. Next, if profitability index is less than 1, then NPV is negative. Next, example for profitability index. So here we require two things: present value cash inflows and present value cash outflows. So if you substitute these things here, then you are going to ascertain profitability index. Here profitability index for this is 1.16135. And next, internal rate of return. It is a discounting technique. It can be interpreted in two ways. IRR represents the rate of return on the unrecovered investments and balance sheet of the project. It is the rate of return earned on the initial investment made on the project. It assumes that intermediate cash inflows are reinvested in the internal rate of return of the project. So these are the techniques of capital budgeting. Thank you for listening. If you like it, share it and subscribe my channel. Thank you so much for watching.